All right, traders, we're on the ES E-mini futures, and this is at the market open. Now we're on the 30-minute chart, as you can see on the ES E-mini 500. It is 9:30 in the morning. The markets have just opened. All right, I'd just like to point your attention to a few things. All right, so we're above the 8-period EMA, which is the red line right now. So we see that we are in bullish territory for the time being. This is the 20-period moving average in the blue line right here. And also we are trading above the 200-period moving average, which is this white line in this area. Now also, I'd like to point your attention to the CCI, which is at the bottom of the screen. And as we can see, the oscillator is above its positive 100 line. So that means that it is very bullish. So we have three lines on the CCI. Now the CCI looks exactly like the RSI, but it's two different animals altogether. All right, so let me point your attention to the three bars. Okay, so we have the top bar in this area, which is the positive 100 line, and the one that's in the middle, that's the zero line, and also the negative 100 line in this area. So as we can see, guys, the market has decided that it is going to go bullish for the time being. So what I'm going to do is go down to the 5-minute chart, and as we can see that we have a jump up off the 8-period EMA. So this tells me that there's a 75% chance that it'll go in that direction for
Order
the
filled.
duration of the time. So what I did, I just now entered in the market. So I just bought 5 contracts off the ESE mini futures. All right. So what I'm gonna do is put my stop loss right below the structure. Now I can easily go ahead and put it, let's say, right in this vicinity, right below the 8-period EMA. However, what I'm going to do is just put it right below this area. So that is the 5393 position, right? So I'm going to take it down to the 5392, 5392. So all the way down here. All right, so that's in this area. So you can't really see it on the screen, but we are, our stop loss is right in this position. All right, so far so good. We were up 700. All right, so we'll see what happens with the candle. So if this candle closes, right, I'm going to go ahead and put the stop loss right below the prior candle close. All right, so we're right there. Okay, so what might happen? We might have a slight pullback into this area. Doesn't seem like it. It's very bullish this morning, guys. All right, so the next step, what I would do is just wait until this candle closes. So as this closes, guys, what I'll do now is I will go ahead and move my stop loss right below that candle close. Okay, so nice and easy. Nothing too complicated. I mean, that's all we do. And if you do the one candle close, guys, I promise you, I guarantee you that you will last in this business forever. Like you're gonna have bad trades. Let's face it. But we have to learn how to lose, or how to lose properly. So once we commit to the one candle close, it's on. So we're looking so good. We have the price action that's above the 8-period EMA, and the 20, and also the 200-period moving average. All right, so this is a perfect setup. This is what we want to see, right? If we're going to bullish. All right, so everything is pointing to the upside. Um, Again, we might have, you know, a temporary push back to the downside. So the market needs liquidity to continue. So I I'm convinced that there's probably some contracts in this area. So in order for the markets to continue on, it's going to need to pick up a few contracts to continue. That's okay. All right. And there's a possibility that it'll probably come all the way back down to the red line, right? Our stop loss is right in this area. So when we trade, we're never too trusting of the markets, right? We have probabilities, we have the possibilities, but as professional traders, what we do, we look at the probabilities instead of trying to predict where the market's going to go. We try to ascertain, okay, the probability of the move is to the upside, and we predict, or we try to determine where the markets won't go, or least likely will go, instead of trying to say where it will go. All right, and that's been working well for me for the past 20 years, and yeah, guys, pretty much we look at the 8 period EMA. That is the main moving average that we use. The 8 period EMA is the red line, and like I said before in the other videos, the markets respect the heck out of the 8 period EMA, and so that is our trigger line. So that's where we enter our trades, and also that's where we would stop out or get out of the trades in the worst case scenario. So that would be our first line, literally line of defense, and then the 20 period moving average would be the second line of defense. So in a worst case scenario, that there's let's say there's a crash, that it'll an aggressive reversal in this area. We would say, all right, the probability of this thing going to the blue line is unlikely. It's least likely, but it is possible that it could do that, right? So we always prepare ourselves. We always tell ourselves, hey, the market is going to do whatever it wants, but there's a probability that it will do a certain thing the way that we want it. So essentially, we're always vigilant and very careful of what might happen. All right. So as far as we trade in the market, guys, we are confident in our strategies. However, we also believe that there's always that possibility that the price action will not go in our favor. All right. So far, so good. So what I'm going to do now is move our stop right in this area. All right. So this is where the stop line is. All right. So we went ahead and moved the stops. I'm going to draw a line so that you guys can see it a little better. All right. We moved our stops. Oh, I messed up. Hold on one second, guys. um, yeah. So we moved our stops in this vicinity right here. I'm trying to draw a better line for you guys. All right. So we noticed that, all right, this candle's closed, and we're gonna get it just right. So we want to move our stop loss right at the beginning of the prior candle close, right? So you don't want to be too close. For example, you wouldn't want to put your stop loss in the middle, because what might happen is that the price action might come down and stop you out in this area. So you want to be, if you want to be conservative, you can go ahead and put it maybe somewhere in the first quarter of that candle. However, I think a safe place to be is right either by the beginning of the body, or the beginning of the wick. Now it's up to you guys. How do you want to do this, right? I'm not going to tell you to put it next to the body or put it next to the wick. It's a personal preference. All right. So far we're up almost 5 grand, and in just a short period of time. And what I'll do is I'm gonna go ahead and scale off. I'm gonna take off, the 3 contracts.
Order filled.
All right, so now we only have two contracts that's working for us right now. So that's it. So our two contracts that we have remaining would be considered our runners, right? So we just keep those in play, and we'll see what happens. If we get stopped out, if it turns against us, it's okay. We're already locked in. We already paid ourselves. Um, three grand already. So we're in the money. We're good. We're not stressed. This is just cherry on top of the cake. And so what I'm going to go ahead and do is move our stop up again. All right, because we notice, okay, this candle closed, and we put our stop loss right where the body begins or where the wick begins. So in this case is where the body begins. So that's it. It's like a lockstep up. Every time it jumps up, and every time that candle closes, we put our stop loss right below the beginning of the candle that's closed out, and just like that. So we'll continue to lock in our profits as price action go in our favor. All right, so that's it, guys. If you like what you see here and you like these videos, please subscribe to my channel and also press that like button. Thank you so much, guys, for listening, and I'll see you on the next one. Okay, bye bye now.